Welcome to Living Your Greatness. Each episode, we bring on great people to inspire you to achieve your greatness. We discuss topics all related to health and wellness. Listen to world-class stories, learn valuable lessons, and turn knowledge into action. It is now time for you to unlock your inner greatness. Welcome back, everyone, to another episode of Living Your Greatness. This is your host, Ben Mummy, and today we have a new guest to the show, and his name is Gary Wagner. For those of you that don't know Gary, he's actually the producer and the CEO of the goldforecast.com. It's a daily video newsletter covering precious metals. He has been a technical market analyst for over 35 years. And since 2010, Gary has been a regular analyst for Kitco News, where he authors daily commentary on the Hawaii 6-0. So Gary, it is a pleasure to have you with us today.
It's great to be here, Ben. Thank you so much for inviting me.
Awesome, Gary. Yeah, no, it's great to have you here too, especially because we just met only a couple weeks ago in Vancouver at the Vancouver Resource Investment Conference there, organized by Jay Martin. And it was really cool too, how we kind of just stumbled into each other there before going to a cocktail party.
Literally, and I thank you for that.
Awesome, Gary. Cool. So let's kind of get hopping in here, Gary. Tell us a little bit about yourself. Where did you spend your formative years growing up? And what inspired you to become a technical market analyst?
Okay. Well, I was born and raised in Michigan, went to Michigan State University. In 1983, I made the decision to move out to California. It was too cold in Michigan, is really the reason. And plus, I'm a very mediocre to bad musician, but for some reason, I wanted to go out there and rejoin a band that I was in with a guitar player. However, my mother said, if that's what you want to do, go ahead and do it. But before you do it, I want you to meet one gentleman, which was her best friend's daughter's husband. And I said, of course, I'll go do that. And I went into his office. The office was American Precious Metals. I had no real idea about gold, silver, commodities, and the alike. But when I went in there, I was smitten. I was dazzled by rows of brokers sitting there with amber screens, buying and selling gold, and kind of the energy level that was there. And so that's what got me into trading metals itself. In terms of becoming a market technician, I spent about 2 years there and then actually went and got my what's called my RR, which is I became a registered commodity broker and formed a company called International Pacific Trading as an IB, an introducing broker, to actually trade commodities themselves. And I quickly realized my first 2 years that I really didn't know what I was doing. And when I would listen to analysts on the news, I would hear compelling fundamental arguments why they believed that these stocks were going to move higher. Absolutely logical, and seemed like that they knew what they were talking about. And I turned the channel and there would be another analyst, and he would be talking down that same stock with a very, very compelling argument and reason why he thought that stock was going lower. And I realized that there was too much ambiguity in terms of how you interpret market moves. And I thought that the one thing I know is very black and white and not gray is math and technical analysis. I was very fortunate in that I started working for a small television station. This is back in the day when they had UHF and VHF. And John Bollinger, the gentleman that created Bollinger Bands, was the manager for technical analysis for the station. He took me under his wing, and I was smitten at that point with technical analysis.
Awesome, Gary. It was really cool to hear about your story, how you became, a technical market analyst. And something that I kind of want to move to here, I know your work office is actually virtual and it's worldwide. And I know you're actually from Hawaii. That's actually where you're living right now.
Correct.
But I want to know, how is it to have a virtual office, and how do you like living in Hawaii?
First of all, I love Hawaii. I traveled all over the world giving lectures. I wrote my first book in 1993. And John Wiley, my publisher, sent me on a worldwide book tour. I also lectured extensively throughout the year in my more formative years. And Hawaii was just a perfect place. They speak English. It's paradise in that we are literally in a beautiful part of the world. It's in the middle of nowhere, but at the same time, because of its isolation, 2,500 miles from the mainland and 2,500 miles from Asia, I could look at all of the markets in terms of the time span, because there was a major change, especially in the futures markets as far as gold was concerned, in that it moved to a 24-hour market. And so it allowed me to view the markets for a great swath through London, Hong Kong. And actually, the one thing I do typically miss is the open in New York because of the price, because of the time difference. So a virtual office to me is the only way to go.
And as I'm actually interviewing Gary right now, he is wearing a Hawaiian shirt. So he's really embracing, obviously, where he's from. But something that I want to move to next now, Gary, is for my listeners who are listening right now, some people might not even understand first, what exactly a technical market analyst is. Could you define what it is and how this skill set has kept your emotions secure and as well as helped you thrive as a trader?
Absolutely. First of all, the key distinction between the two groups of analysts are those that look at fundamental events and those that look at mathematics or technical indicators. The way that I like to think of it is technical indicators are simply a distillation of fundamental events, and they're interpreted or turned into numbers. So Western technical analysis, we're looking at things like moving averages, stochastics, which is a basic model that compares current price to the highest high over so many days and the lowest low to see if a market's oversold or overbought. What compelled me to move to that direction, as I said, is that it seemed logical and my emotions could easily be swayed by fundamental news or analysis by different economists or fundamental market technicians. What drew me and sealed the deal, so to speak, in terms of technical analysis is during my formative years, I had a client. His name was David Moore, an engineer from, he worked for GE, he lived, I believe, in Connecticut. And whereas I saw clients make money and lose money and a whole bell curve in terms of a success rate, I witnessed this gentleman literally sell the tops of markets and buy the bottoms with uncanny success. And I'd never seen a trader that had that kind of accuracy. And he was an engineer. He did this in his spare time. And so after a couple of months of witnessing his success, I said, David, what the heck are you doing? Because you're selling into a market where I'm bullish, everybody's bullish, and it seems like the very next day the market tops and comes down. And you're doing the same thing on the bottoms. He said, well, I can't really explain it to you. It's rather complicated. In my mouth, I was kind of sad when I heard that. He said, but I'll send you the book that was my pivotal insight into this way of trading. And it's a style called Japanese candlestick charts. I thought, okay. He sent me the book. It was by Seiko Shimizu, The Japanese Chart of Charts. It was the first book translated by a Japanese trader into English back in 1990. And at that point, many of the charting services had candlestick charts rather than a bar chart, but no one knew what they meant or how to interpret them. And because it was translated from Japanese, and think of the linguistics, that's kanji and languages define how we think, it was a very, very difficult book to read, very almost cryptic. And it really took me about 2 or 3 times before I got a grasp of what he was trying to convey. But once it clicked, once I understood what he was saying, it conformed, it changed the way I traded, because now I was able to identify potential tops and bottoms in the market. And that was used by understanding Japanese candlestick patterns. The difference is if you look at a bar chart, it uses open, low, high, and close. And it's a vertical line, high, low, it has a little hash mark on one side that represents the open and a hash mark on the other side that represents the close. The difference between drawing a bar chart and a candlestick chart is simple. They draw a rectangle around the relationship between the open and close, and they fill it with one color, typically green if it closes above the open, red if it closes below the open. But the key difference is not that color, it's how the Japanese view a trading session. Because if I was to say to you, for example, that the Dow Jones Industrial Average closed down 45 points, intrinsically, you understand what I'm saying is I'm comparing today's close to yesterday's close, correct?
Mm-hmm.
Okay. The Japanese don't believe that that's the most important thing to look at. See, as a Western trader, you focus on a close-to-close basis on a chart. The Japanese technical analyst looks at the relationship between where the market opens at the beginning of a trading session and where it closes at the end, because to them, that day is a battle. And if it closes higher, it means that the bullish faction were able to win that particular battle. In other words, they were able to dominate their positions and move prices higher, and the reverse for lower. And so that shift in thinking about a market from close to close and thinking about a market from the open to close of that session was a game changer. And so I advise anyone that is looking at trading the markets, whatever market that is, and is interested in technical analysis. I mean, I got my basic training in Western technical indicators, and they by nature are lagging indicators. In other words, a moving average is telling you what happened over time and average regardless of the cycle. And so it always lags behind the actual price. Whereas a Japanese candlestick pattern actually lets you know a pivot is about to take place because of the formations, the way the candles look as a pattern. And so it's a leading indicator. And that was a key difference.
Awesome, Gary. Well, thanks for, explaining what it is and also giving, that detailed explanation of like the Japanese candlesticks, because, when it comes to the technical analyst side, that's my weakness, because I'm more of an investor where I look at the fundamentals of the macro picture and then the micro picture of things that I'm investing in and making sure I understand. But I also know that it's super important, critical, that in the meantime, while I'm learning about the charts through people like you or Steve Penny or Chris Vermeulen, like the experts in this field, I'm also realizing that this is a blind side that I need to work on. So I appreciate you for talking about that. So something that I want to move to here, Gary, inflation has been a big concern now, in the past, year and a bit. People are starting to realize that it's not transitory, it's real. Everyday people are realizing it, in gas prices, as well as lumber, used cars, like the list goes on. How would you suggest someone that's listening right now to position themselves? Because it is a very fearful market.
Absolutely. I mean, first of all, go under the assumption, the true assumption, that inflation is at a level we haven't seen for 40 years. So all of the millennials, but many people have never experienced inflation like we're looking at now. And it is ridiculously high. And when looking at the financial landscape, you have to understand that certain things will do well, but as a whole, what you're going to get is extreme volatility in all of the markets. So if you're looking at inflationary pressures moving up, the first thing you can assume is that central banks worldwide will begin to ratchet up their interest rate. In the US, we call it the Fed funds rate. Every central bank controls the interest rate for all of the dynamics for that company, that country, and all the companies doing business there. So if you have higher interest rates, let's say in the equities markets, you might want to look at some of the banking stocks, because when interest rates were artificially low, in the US, they were between 0.25%. The banks cannot make a whole lot of money. And when they move higher, of course, the banks will do better. The other thing is that Gold, for example, and the dollar tend to be a good hedge against inflation. People will move from different asset classes into what's called the safe haven group, of which gold is probably the strongest. So I recommend in times of high inflation, as we're seeing now, that all investors have a minimum of, say, 10 to 15% of their portfolio in physical accumulation of gold or silver. So if you have $1,000, I'm just using a number, you want to have about 1,500 of it in gold and silver. It's just something that will, over time, stay stable and perform well when everything else is having wild price swings. So that's one thing you want to consider. The other thing is you'll get commodities rising. I mean, what is the definition of inflation? The dollar or Canadian dollar, where you are, or here, the US dollar, doesn't buy as much with the same $1 bill, $5 bill, $10 bill. And if it doesn't buy as much of a commodity, turn that around. That means commodities as a whole will rise. So that's something else you want to consider. And you want to tie up your money in some sort of a vehicle that's safe. Now, that being said, there is no shoe that fits all sizes. In other words, depending on your age, your tolerance for risk, what you're looking to achieve, that will determine how you design a portfolio and what you'll allocate, what percentage you'll allocate into a sector. The older you get, if you're an old person like me, you want to have more safety, so to speak. And if you're young, typically they suggest that you're willing to take on more risk because you have time to make that up. I tend to believe there's a partial truth to that. You should always invest in the wisest sector, but that's what will determine where you put your money. The key is if you're in your 20s, your 30s, your 40s, regardless of where you're putting your money, the most important thing you can do is allocate a percentage of your income into, whether it's a retirement account, an investment account. It's consistency over time that will make a significant difference in your life as you approach your 50s and 60s or retirement. Retirement's an odd thing. I'm retired, but I still wake up and work every day, but I do it because I actually love what I do. But there are many out here that are forced to work because they can't comfortably live on the amount that they've saved, plus what we have here, Social Security. So the key is to set aside money every month when you're younger, and that will benefit you as you get older, regardless of what you invest in. But be consistent. Do it every single month. And that is my recommendation.
Awesome. Thank you, Gary. Yeah, no, I think consistency is definitely a good point there to highlight. And I think also, kind of like you were saying as well, making sure that you're investing in something where your wealth is going to be preserved as well as continue to grow, right? And
Correct.
Like you said, in terms of the percentages, it obviously depends on your age and kind of your risk factor, how much risk you're able to take. And this actually leads to me asking you another question, which I know there's been a lot of talk, probably even for the last year and a bit, about a real crash coming into the stock market. And, we've obviously seen in the last, let's say a month and a half, a big drop in terms of the stock market. But there's still a lot of talk where we could see a really big drop further. So my question to you is, in the last year, gold has done a pretty good job at maintaining its value, especially if you compare it to maybe other investment decisions that you could have made. It's really preserved its value. So if this were to happen, of a crash happening, what would happen to gold?
Well, let's look at the macro view, first of all. Typically, equities, if you look over the last 10 or 20 years, has performed in a stellar manner. I mean, depending on the stock you bought, buying Facebook at $14 when it came out, it's worth $200 now, even after coming down. The potential return far exceeds whatever you're going to see in gold or silver or something that's a more stable commodity, let's say. Is the stock market oversold right now? Is it going to test lower lows? Honestly, I don't know. What I can say is historically over time, it does well. Every time we've seen a market have a correction, which I believe is defined as a 13 point to 20% drawdown in value, it has recouped and moved to a higher high. It's done that consistently since 1920s when we had the big crash. So what will it do? I don't know. I can tell you over time, it's most likely that if it does have large sell-offs, there's an adage, buy when there's blood in the streets, meaning after that sell-off is probably the best time to buy, but it's when the retail investor is most scared to enter the market. And so the professionals are the ones going in and buying that dip. There's no answer to that. Will the stock market continue to move lower? It could. Right now, the Federal Reserve, if they really put their foot on the gas pedal in terms of raising rates quickly and more aggressively, it will cause an economic contraction. It has to. Corporations in the Western Hemisphere, Canada, the United States, have become addicted to free money. When you have an interest rate of 0 to 0.25%, businesses know how to make money with money, unquestionably, and they're very good at it. So when it's free money, it's really pretty easy to make money. As that cost of borrowing moves up, it gets a little bit more difficult. So realize there's always going to be peaks and valleys, a cycle in business, in economics over time, in which you'll have a period of growth, and that will be followed by a period of decline. And so stability is important. In terms of the macro view, I can't tell you what I think the stock market's going to do a year from now, but I can tell you that when I was first introduced to US equities, my mentor made a simple statement to me that has stuck with me all my life. And he said, Gary, it is not a stock market. It is a market of stocks. Selection. There's always going to be different companies that tend to do real well. My personal belief is buy what you love. I happen to buy Tesla because I adore Elon Musk from what he's doing intellectually, what he's accomplished. I mean, my God, when I was growing up, to think that there would be an individual that single-handedly would be able to produce and create electric cars, or have rocket ships that landed after they took off, that weren't just throwaways, one use and throw it away, or that had a vision to take people to Mars, in which I absolutely believe he will accomplish. I mean, that is a once in a lifetime type individual that comes along and transforms the world as we know it. So I like to invest in Tesla because I believe in him. And I've had periods where I've made money, where I've seen it decline, but it doesn't matter to me because I think overall, the macro view is that company will continue to be worth more, even though it went from 1,000 back down to 700. Doesn't matter. That was the time to buy more if you can at 700. Buy what you like, enjoy your life, and set goals that are realistic.
Those are definitely some really great points that you brought. And I think you hit the nail on the head when you brought up Elon Musk in terms of an example of a world-class entrepreneur and someone that has been, like you said, extremely creative, extremely innovative, and just extremely driven, to kind of being a winner, right? And succeeding at everything that he's done, right? So I appreciate you for bringing that as an example of, picking something that you like and picking that good leadership and that good company where it's a real value. Something that I want to move to next, Gary, I want to go back more to your strength here, which you are a trader. If someone wants to make a better decision, and buying at a low to sell high, how can someone develop the technical skills to gain an edge over the other investors in a market?
It's an interesting question. These adages, buy low, sell high. I mean, buy when there's blood in the streets. There is truth to all of them in its quote, its simplicity, in its execution. It's difficult, if not nearly impossible at best. Find traders that have had success in the past, read what they've done to get there, and then mimic those actions. Find enough of them so you can find what your wheelhouse is, what you're drawn to, whether it's technical or fundamental analysis. If it's technical, which studies seem to resonate with you. Trade markets that you have some knowledge in. If you're a farmer, for example, and you're going to trade commodities, look at the grains, because you have an intrinsic background about how grains work, that they're seasonal, that they typically cost so much per acre to produce and what you typically yield. Things that you're familiar with, that you have a background in, will give you a head start every single day. But look at professional traders, as well as people you might know that are successful. Find out what techniques they have used to become successful. Mimic those techniques. Look at others that do the same thing until you find a combination of different types of, whether it's technical studies, fundamental analysis, that resonate with you, and you'll be at your best. There's no answer to that. For me, I resonated with how the Japanese viewed the market and Japanese technical analysis, because I realized that they were doing something in a very unique way that produced incredible results, and it was a leading indicator. I also have been drawn to Fibonacci. We use what's called Fibonacci retracements and extensions, and the idea behind it is the basic sequence of numbers that he developed, and you can look that up. And to me, there's some universal truth to that. I am also been drawn to Elliott wave theory. And here's a market technician from the 40s and 50s that some very knowledgeable, astute professional traders think he's absolutely a quack and his ideas are nonsense. And those that are professional traders and think that what he had was brilliant. I tend to fall in that latter camp, because what he recognizes that markets move in cycles and that they can be identified to some extent. The problem with Elliott wave is it is a art as well as a science. So different people create different models, and therefore it's not as black and white as, let's say, a moving average. If a stock or commodity is trading above a 200-day moving average, all market technicians say on a long-term basis it's in a bullish or bearish trend. You don't get that with Elliott wave. Now, what I've done is combine Japanese candlesticks with Fibonacci theory and Elliott wave theory all together. And that is my technical system that I've created by looking at doing just what I recommended that your listeners and viewers do, which is look out there to find people that have had successful techniques, learn those techniques, mimic those techniques, and move on to other ones till you find a combination that resonates with you.
Awesome. Great, Gary. In summary, what I have right there is find a really good mentor, find a community that's supportive, and be a continuous learner. So I appreciate that. So Gary, what do you believe separates a good trader from a great trader?
Fortitude, persistence, and an understanding that you're always learning. And the more you believe you don't understand, probably the better you're at trading. In other words, there's no end to searching for knowledge. And once you find techniques, learn how to mimic them. But the difference between a good or great trader is the great trader makes the same mistakes as a good trader, but he learns from them. He adapts his style. He then goes back into the battlefield, so to speak, and he has a no quit attitude. The good or mediocre trader has periods of growth or success, but then when they're faced with adversity, they kind of throw in the towel. That's the only difference. Some people have a better aptitude to pick things up in certain ways too, but the difference, the great traders, what differentiates them is they were able to adapt when they made mistakes. All traders do. All traders have points in which it's difficult. The great traders learned from that. The good traders did not.
That is well said, Gary. I don't even think I could paraphrase that. But what I did get is, to really learn from your mistakes, stay humble, and use those mistakes as a future win, right? In terms of getting better.
As a
and
learning
improving.
tool. Yeah.
Learning tool. Cool. Awesome. So, Gary, as you know, the purpose of this podcast is to inspire millions of people to achieve greatness and enhance their overall personal well-being. So what is your definition of greatness?
My definition of greatness is to wake up in the morning and to be excited about what you do. Greatness is not how much money you make. It's not the size of your house. It's not whether you have a Ferrari or a Volkswagen. It's intrinsic happiness. Family is important. There's a lot of things that we all know are important, but greatness, success is simply being content and happy with each day that you're above ground. If you can do that, you've done it. It's simple. Just be happy with what you do.
That's beautiful, Gary. So you guys heard that. Be happy with what you do. So Gary, one last question I just want to ask. Where can people find you? And who is a future guest that you'd like to see on this show?
Well, you're going to pick the guests, not me. And it's going to be whatever you're drawn to, but you can find out more about our services and myself at thegoldforecast.com, one word. My son does the Bitcoin blogs, and that's part of the Gold Forecast. Click on Bitcoin if that's where your interest lies. We do have a YouTube channel, but primarily go to thegoldforecast.com. And in terms of guests you should invite, that's not for me to answer. It's for you, the people that you're attracted to. But thank you for taking the time and letting me speak my mind.
Thanks so much for being here today, Gary.
Great. Have a great day.
Thank you for listening to the Living Your Greatness podcast. If this show has added value, please subscribe, leave a rating, and make a review. This podcast is for informational purposes only and is not to be considered personal, legal, or investment advice or a recommendation to buy or sell securities or any other product. It is based on opinions, current events, press releases, and interviews, but is not infallible. It may contain errors, and Living Your Greatness offers no inferred or explicit warranty as to the accuracy of the information presented. If personal advice is needed, consult a qualified legal, tax, or investment professional. Do not base any investment decision on the information contained on Living Your Greatness or our videos.